the GDP rising at a 1.1% annual rate. Consumer spending drove the increase, weighed down slightly by a slump in business investment. Joining me now with what the markets are making of all this is Tom Essaye, Sevens Report research founder. Thank you for joining me this morning, Tom. So as we see here with this new GDP data, and then what we saw with that sort of slumping in business investment, what are we making of this GDP report?
Good morning, Rachelle. Thank you very much for having me on. GDP is quite a complex number. So the headline is weak, but actually the details of this report are strong. The main reason the GDP underwhelmed was because of a big drop in inventories. But when we think about kind of the normal functioning of the economy, inventories aren't really super substantial to if you think about how our business is doing. So the underlying metrics actually showed pretty solid growth in GDP. Here's the problem. It's a backward-looking metric, right? We're talking about January to March. I mean, here we are on the doorstep of May. And markets care about what happens next. And the economic data over the past month has been mixed at best. And so it really remains very unresolved. Are we going to get this sort of hopeful soft landing where everything works out great? Or are we going to get a hard landing where everything does not work out great?
And to that point, then, if you have consumers who do seem willing to spend, but you also couple that with lower inventory, this should be good news for the markets.
Yes, it should. And I think that, seasoned analysts know to look beyond the headline of the GDP report. Again, it's not as much as a market mover as sort of it's made out to be because it is a static number. But the bottom line is consumer spending is still strong. And I think that we can expect it to continue to be relatively strong until the unemployment rate starts to move up. I mean, at the end of the day, if people have jobs, they're much more willing to spend than if they do not, right? It's the loss of that job or the fear of the loss of that job that really restricts consumer spending, and we're just not there yet.
And of course, want to talk about the debt ceiling standoff there, as we were just talking about it, and some of the volatility that we do tend to see when we get to that sort of point of the brinkmanship. What are the expectations there, and how should investors really be viewing this period?
So sadly, I think your previous guest was spot on. It's almost entirely likely we will walk right up to the doorstep of this disaster, and then at the last minute, there will be some sort of a deal. But we're going to have to go through some volatility. And I think that really from an investor standpoint, you need to look around and make sure that the volatility in your portfolio is where you want it to be, right? So if that means you have to go a little bit more defensive, if that means you have to raise a little bit of cash, do we call it the sleep at night number, right? Find your sleep at night number. So if markets do get very volatile, you feel comfortable about it. We think one of the best ways to do that is to overweight defensive sectors. Things like utilities, staples, healthcare, a minimum volatility ETFs, because even amidst this craziness we're all about to likely endure, you can rest assured that your portfolio, while volatile, isn't as bad as it could be.
So then with the Fed keeping an eye on potential, volatility from debt ceiling issues, and then also sort of still working through some of the financial stability that came from the SVB fallout, and as we're still seeing with First Republic, they're still bearing the brunt of that. What are the expectations then for how the Fed navigates this when you add in things like, as you mentioned, still a strong, a very tight labor market as well?
Yeah, the Fed is really in a pickle here, and it has been in for some time. And whether or not it's of their own making, we can debate. But it doesn't really matter at this point. If we look back to 2011 to the debt ceiling drama, your previous guest was absolutely right. The market did recover after the debt ceiling was passed. It took about 6 months, but there's an important caveat there. That came with more Fed stimulus via something called Operation Twist. There is zero chance anything like that happens this time around. So if the debt ceiling causes significant market turmoil, no one should be hoping or expecting that the Fed will come in and ride to the rescue. They will not be able to. And I think that raises the stakes on this debt ceiling drama even more. And unfortunately, if it does cause a decline in stock and or bond prices, it's just going to make it all that more sort of shameful that we're shooting ourselves in the proverbial foot here.
I mean, when you factor in also tighter lending conditions from the bank fallout, you put in your notes about First Republic perhaps being the next or the last shoe to drop. What would be the next shoe to drop then in this scenario?
Well, you want to look at sort of the banks that have the most uninsured deposits and some other names to watch. Again, I'm not trying to indict these banks. I'm just saying keep an eye on them. Things like a Zion, a Western Alliance Bank Corp, and a Comerica. Those are some of the banks that the market perceives to be not weak, but they are sort of more vulnerable to what's been going on than, say, some of the larger banks. So keep an eye on those three. If and when FRC fails, because it's entirely possible that it will be taken over by the FDIC. It's not done yet, but something has to happen there. Then you want to look to the next banks and see how those stocks trade. If they all of a sudden start going into free fall, that's not a good sign.